Hey guys, in this educational video, I will teach you how to identify head and shoulders pattern and how to treat it. First, we will discuss the theory, we will discuss what is the logic behind this pattern, and then I will share with you a real market example. Please don't forget to like this video and subscribe to my trading view page. So let's start with the basics, traders. What do we know about the head and shoulders pattern? Head and shoulders pattern is the reversal pattern, and we use that to predict the violation of a bullish trend and the initiation of a bearish trend. Remember, traders, that in a healthy bullish trend, the price keeps setting higher highs and higher lows. And as you remember, according to our rules, the market starts trading in a bullish trend once we have the initial bullish impulse, the retracement with the higher low, and then the next strong bullish impulse with the new higher high. Once we see the price action like that, we see that the market is trading in a bullish trend. And we expect the continuation of the bullish move in such a manner. But of course, occasionally the market reverses, occasionally reaching some important structure, bears start pushing and bears violate current bullish trend. And what are we looking for to confirm a trend violation? We always are looking at the last higher level. To us, the last higher level is a very important structure. Yes, and from that, we always expect a strong bullish reaction. And we see that till the price is trading above the last higher level, the market remains bullish. So imagine the situation that the price drops. The price drops to that higher level. We expect a bullish movement from that. And instead of setting a new high, the price sets a low high and drops again to that horizontal structure. What does such a situation tells us? It tells us that buying pressure from that support is weakening. But of course, such a price action here still doesn't mean that the market is reversing. For now, that structure is still respected. And analyzing the price action, you can see that here we have a bullish movement with high retracement and a higher low, then the next strong bullish move with a new high lows, retracement, and here we have the equal low. Then the market bounces and set a lower high, yes, and then returns back and sets equal low. We call such a price action a head and shoulders pattern. Yes, and such information by itself is an important warning sign. Once you see such a pattern being formed, it is not the signal for you to short. Instead, it is just a warning. Yes, it indicates a potential coming reversal. And what is the exact signal that we are looking for to confirm a trend reversal? We are looking for the violation of the last lows level. Yes, the last high low, this equal low right here, compose a horizontal neckline. Yes, and that neckline should be broken to the downside to confirm a coming bearish movement. The funny thing about the head and shoulders pattern is the fact that once the price breaks a neckline, we already have a bearish trend. We have the initial bearish impulse, the retracement with a lower high, and then a bearish movement with a new level low. So once we see the price action like that, we see that the market is no more trading in a bullish trend, it is already trading in a bearish trend. And then usually on the retest, we open short position, we set stop loss above the highs of the pattern, and we expect a bearish continuation to lower structure levels. Yes, following such a strategy, most of the time we have quite nice risk to reward ratio, right? Now let's discuss the example. I wanted to discuss with you pound yen pair. On the pound yen pair, take a look what I spotted, traders. Here on a daily time frame, the here is currently approaching a very strong resistance. Yes, we have a very strong structure here that the market is approaching right now. And watching what is happening on intraday time frames. On an hourly time frame, we see the market trading in a bullish trend. Let's analyze the price action right here. We have here a bullish impulse, retracement, and here the price sets high low. Then the market bounces, sets a new high close. Then we drop, we respect the previous low, and then we bounce again, setting a low high. Here we have a potential head and shoulders pattern, and at the moment the market is completing right shoulder. And here for us, the most important thing is to correctly identify the boundaries of a neckline. When you draw the neckline, consider the candle closes of the last lows and the wicks. So our neckline will be like that. The market will reverse. We will see that the market violated a bullish trend and initiated a bearish trend only after violation of that horizontal neckline. Once we see the hourly candle close below, we will short on a retest and we will expect a bearish movement at least to that support. With our stop loss lying above the right shoulder, here will be our risk to reward for the first target. And then, of course, if the price violates that support, the market may drop much lower. Yes, I hope it is clear. So let's conclude, traders, what we discussed. Head and shoulders pattern by itself is not a signal for us to short the market. Yes, we apply this pattern as the warning sign. However, the trigger that we are looking for to short the market is the breakout of its horizontal neckline. Only when the neckline is broken, we short on a retest expecting a bearish continuation. I hope that my explanation is clear, traders. Let me know if you have any questions. Also, please like this video and subscribe to my trading page.